trifecta of disappointment: manufacturing, non-manufacturing, and a tepid jobs growth. Is that enough to assuage the Fed from moving in 2016?
So I think if you take a step back and look at what markets' expectation was at the beginning of the year, I think it was for further rate rises in the US, for a strengthening dollar. And those expectations obviously haven't been met, and therefore interest rates in the US have been held at a lower level probably than the expectations at the beginning of the year. And that has certainly helped financial assets in the US. It's resulted in a weaker dollar, and when the dollar is weaker, it can't be weaker in isolation. It's got to be weaker against something else. And what that's in effect done is put upward pressure on both the euro and the yen, and force those particular stock markets into very difficult periods. So in terms of what the numbers actually look like, our view is that the US recovery is actually relatively robust. These data points tend to be very volatile, and one needs to look at the trend rather than just the individual numbers.
We've got an expectation now in markets, a probability of a hike of just 52% out as far as December. So the market is, in danger of not banking on a rate hike this year at all. What does your investment strategy look like then if we don't see the Fed hike this year?
Yeah, so our expectation is that the Fed will hike probably once this year. That is on the low side, and I think what's actually even more interesting is the fact that there are so few rate hikes built out even into the end of next year. And our view is that that is quite complacent in terms of the potential for rate rises to surprise the market.
So you're not too bothered by some of this weak data we've seen?
So we're not too bothered by some of this weak data. I think one needs to focus on a 2 to 3 year time frame and say, where do you think the trend on this is actually going?
Before we get into this chart, you say market's underpricing next year. The Fed has guided us for 4 hikes next year. What do you think potentially is next year in the hiking mode? So
our view in general on the Fed is that the direction of travel is for rates to actually rise, not to the levels of history. So therefore, people who are sort of wedded to that anchoring of the 1980s and 2000s yes. are probably mistaken. However, it is quite plausible that the Fed would raise 3-4 times next year if the economy continues to recover.
Preparedness for markets then. Timely. You're a very good guest. You talk to the charts. BTV 33.44. If you want to have a look at this, this is US 10-year yield dipping below the dividend yield on the S&P 500. What happens every time we've seen that? 2008, bang, ratchets higher, bang, taper tantrum at the end of 2012. Are we getting ready? Are we readying? I mean, bonds have had a stellar run. They really have delivered. High yield, 14% so far this year. Investment grade, 10%. Are we beginning to see the beginnings of a bond backlash?
First of all, it's very difficult to pick an exact turning point in a market. When you have interest rates that have been suppressed to the levels that they have been suppressed, what you can expect, particularly from bonds, but in fact all financial assets, is that the future returns are going to be lower and the volatility associated with those returns is going to be higher. When you look specifically at fixed income, I think it's very difficult to say there's going to be an immediate sell-off. I think the ability to time that exactly is very, very difficult. What we would say is if you have the investment flexibility to simply not hold this asset class within your portfolios, that's probably a prudent approach. But to try to short it is very, very difficult.
What about corporate bonds? Some companies are now being paid to borrow. We saw this yesterday with some non-financials issuing debt at yields lower than zero. Does that interest you?
Not at all. I think if you take a step back from some of those numbers and say, does it make financial sense for me to give my money to a private company and for me to pay them for that privilege, I think that doesn't necessarily make sense, certainly in my mind. And unless you are forced by your mandates or some regulatory obligation to do so, that's not a financial investment that's of interest to us.
If you had to make, I know we're desperate, if you had to make the choice then between investing and cash, would you go to cash rather than investing in a negative yield?
I think the issue is most of the cash, certainly for institutional investors, is also negative.